Good afternoon and welcome. I think we've got everybody with us now. My name is Nick Charteris-Black, and I'm going to act as chair for this afternoon's session. And we really thank you for taking time out of your busy schedules to join us today. To give you a little bit of context about this afternoon's briefing, as you can see, it's headed up Reinsurance Market Briefing Zurich. And for us, it's an event that typically follows the Monte Carlo Rendezvous, following on from the briefing that we normally deliver at the Rendezvous on the first Sunday. And some of you may have seen that we did a virtual briefing on the first Sunday, which was the Sunday before last. And today's briefing really builds on that. We've got some similar content, but it has a much more of a continental European flavour. So to start with, I'd like to just introduce our presenters and panelists. So first up will be Matilda Jacobson. Matilda is a director in our analytical team in our relatively new Amsterdam office. And prior to that, Matilda worked for AM Best for a number of years in London. Catherine Thomas, Senior Director Analytics, based in London and heads up our London analytical team. And Angela Yeo, Senior Director Analytics, based in Amsterdam and heads up the Amsterdam analytical team. So they will be our three main presenters and panelists this afternoon. So in terms of the agenda for this afternoon's session, it's really kind of three parts. First of all, the global reinsurance market. So our outlook on the market, and as I said earlier, really building on some of the comments we made ahead of the kind of virtual rendezvous. We're then going to turn to the European primary market, talk about some of the trends there and our market outlooks, and indeed the impact on the reinsurance sector. And then we're going to move into a panel session where we have some pre-prepared topics we want to cover, including the recent FCA business interruption case. Last week, we're going to cover Lloyd's, we're going to talk about trade credit reinsurance, and we're going to talk a little bit about the AM Best stress testing in relation to the COVID situation. And there'll also hopefully be plenty of time for your own questions that we'll seek to address as best as possible. Now, the material for this afternoon's session you can find online. So many of our comments on the reinsurance sector are based on the report that we released at the beginning of the month, September the 2nd, global reinsurers maintain equilibrium through COVID-19 turbulence. So that's available, as it says, on our website, or indeed, apparently if you point your mobile device now, you'll be able to pick up a QR code and it'll take you straight to the report. Similarly with the market outlooks, so the second section of the presentation, these reports were released really during the spring, I guess from probably April onwards through to June of this year, covering the main European markets. And our comments will be principally based on the outlooks plus an update, as things are moving relatively quickly. And again, those outlooks are available on our website. Questions, we do want to get your questions through today. There's really two ways of asking a question. Either email them into webinars@ambest.com. So you may want to jot that down, or I think for most of you, there should be a function within the panel where you'll be able to ask a question, and these should all be getting through to me in due course. So do please ask your questions. Our plan really is to run through the prepared material to start with, then move into the panel session, as I was mentioning, and take all your questions at that time. I think in terms of time, this is scheduled for an hour and a half. We may or may not run that long, but hopefully there will be plenty to talk about. So with that, I'm going to pass across to Matilda, who will open up with some comments regarding the global reinsurance market.
Thank you, Nick. So in this section of the webinar, I'm going to give you an update on AM Best's view of the global reinsurance market. I'm going to start by covering our segment outlook, and then I'll talk about performance and capital in a bit more detail. And then I'll end up with talking about some recent developments. But before I talk about the current outlook, I wanted to set the scene by talking briefly about how we viewed the global reinsurance segment at the end of last year. So going into this crisis, the global reinsurance segment benefited from very strong risk-adjusted capitalization and financial flexibility, but it had also struggled for a while to meet its cost of capital, affected by soft market conditions, low interest rates, and heightened claims activity. We saw that pressure on performance translate into some positive pricing momentum in 19, but I would describe that as moderate and inconsistent. We had a stable outlook on the segment at the time, despite the pressure on performance, but that was supported by the strong capitalization and financial flexibility and by the pricing momentum we saw. So with that, let's move on to talk about what we've done this year. So we've kept the outlook at stable, not because the pandemic and economic downturn hasn't changed anything, but because we see positive and negative forces emerging from it for reinsurers, and that translates into a stable outlook overall. This is a dynamic and very definitely not boring stable, you might say. So let's start by looking at the negative forces on the left. First, there's uncertainty on potential COVID-19 related losses for the reinsurance segments. And added to that, we have pressure on the investment side, where we now face lower interest rates for even longer, increased credit risk, and equity market volatility. While we saw unrealized gains in the first quarter pretty much reverse in the second, this is still a highly volatile environment, and we could easily see further investment losses materialize through the year. Reserve releases have propped up reinsurers' performance in recent years, but this positive effect is diminishing, partly due to social inflation and the impact of that on liability. Sorry, can we go back again? I'm still on the outlook slide. Yeah, thank you. Yeah, so we've seen the positive impact from reserve releases diminishing due to development and property cat losses, and also social inflation's impact on liability losses. And then recessionary pressure leads to the uncertainty about demands for insurance and reinsurance, and uncertainty on future government intervention rounds off the negative forces for the outlook. Counteracting these headwinds are a number of tailwinds on the right side of the slide. Well, first of all, we think the impact on performance from COVID-related claims are manageable as they stand now. And we see reinsurers address their future exposure to pandemics through exclusions. Second, we're seeing much stronger pricing momentum in 2020 than was the case in 19. And that's clear both at primary insurance level and across various reinsurance classes. We think traditional reinsurers are in a good position to take advantage of this hardening, as third-party capital provides their appetite, and as reinsurers seek counterparty security and long-term relationships in a more difficult market. So we had a stable outlook on the global reinsurance segment going into this crisis, and we've maintained that stable outlook since to reflect the balance of these head and tailwinds facing the market as I have set them out here. So I'll now move on to talk a little bit more about performance. I have 3 slides on performance, and they each illustrate the pressure we are seeing on performance for reinsurers, and therefore the importance of increased underwriting discipline. The data underlying the graphs that I'm going to show you are based on the top 25 global reinsurance groups on a consolidated basis. That means that their primary business is included, and both life and non-life is included. The first illustration here on this slide is the 5-year average ROE for these 25 global reinsurers. And we can see the clear deterioration in that 5-year rolling average as we are rolling good years off and bad years in. The picture looks even worse without the positive impact from prior year reserve developments, as you can see on the right. For context, we estimate the cost of capital at somewhere between 7 and 8%. So the segment is not meeting its cost of capital. And I would expect this only to get worse when we roll in 2020 and take 15 off. Oh. So on this slide, I show the 5-year combined ratios. No, sorry, 5-year combined ratios. So combined ratios for 5 years on the bar charts, and the impact of reserve development on the line graphs for 3 segments, right? The European Big Four, US and Bermuda, and Lloyd's. I think looking at this slide, the similarities between the segments stand out more than the differences. For all 3 groups, we can see the impact of cat losses on 17, 18, and 19, with combined ratios above 100%, apart from US and Bermuda in 19. And for all groups, we can also clearly see the diminishing positive impact of reserve releases as that line at the bottom of the graphs goes up. If we switch to the next slide, we can see the, we switch to the next slide here. I'm showing ROE instead, and for the 3 grouping. And here the differences stands out more than the similarities. So here we have positive ROEs for each of the years for the European Big Four. And there you can really see how their life portfolios are stabilizing force when it comes to their ROEs. So in contrast, the US and Bermuda segment has 2 years of negative ROEs in this 5-year period. We should note that the high ROE for 19 for US and Bermuda is pushed up by a large unrealized gain for National Indemnity. But in general, that year was positively impacted by investment performance. And then out on the right, you can see Lloyd's, which shows much more volatility than the other 2 segments. It's worth noting when you look at Lloyd's that performance does not directly influence the capital in the same way that it does for a reinsurance company, because the profit or loss for a year doesn't affect equity, because profit is paid out, and when there's a loss, the market has the ability to require a reload of capital. Right, so I now turn to a discussion of capital, some slides on capital. So on this slide here, I show our estimate of total dedicated global reinsurance market capital. This is based on a collaboration between Guy Carpenter and AM Best in order to create these estimates. And it's important to note that the estimated reinsurance capital is not a simple sum of shareholders' equity for the companies writing reinsurance, because their capital will also be allocated to other lines of business and to investment risk. So AM Best and Guy Carpenter have estimated the amount of dedicated reinsurance capital using our BACAR model and reviewing line of business allocations for the big reinsurers. Now, looking at this number of years we have here, if we see the growth between 13 and 18, we can see that that was driven by third-party capital, while traditional capital was roughly flat. In this period, we saw traditional reinsurers manage their capital through dividends and share buybacks in the absence of opportunities for putting their capital to work. In 19, we see a jump in traditional capital, but that's influenced by positive investment movement, in particular from National Indemnity. So in 2020, we estimate a slight decline in dedicated capital from both sources. For traditional reinsurers, this is the result of the effect of what we expect to be subdued performance for the year, and then partly offset by capital actions. We are seeing, not everyone, but we are seeing some suspension of dividends and share buybacks. And we've also seen some capital raises during the first half, although this is split between primary and reinsurance. We're also expecting a slight decline in third-party capital in 2020, in a continuation of what we saw in 2019. And this reflects a reassessment from some third-party capital providers, given the losses they have suffered in recent years. Within the third-party capital segment, the split between the different types of providers has been relatively stable since 2018, when reinsurance-sponsored managers increased at the expense of dedicated ILS managers. This was due to Markel acquiring Nephila, and so moving that from one to the other. And it shows the increased alignment between traditional and third-party capital. I think we've talked about several times. Yeah, next slide, please. Yeah. So here I'm showing our estimation of the sector's capital utilization, which is shown by the orange line on the graph. And we can see an increase in capital utilization in 2019, which is partly driven by increased investment risk after the increases in the value of investment portfolios in 2019. Prior to that, utilization was pretty flat between 2016 and 2018. We estimate this utilization to go up in 2020. An important driver of capital utilization for reinsurers is net catastrophe exposures, or net PMLs. These have been relatively flat in recent years, as reinsurers have gone back on their CAT exposure or transferred more to ILS providers in the soft market. But we would expect that to change in a hard market, and so for increases in net PMLs to drive capital utilization up going forward. Next slide, please. So the final thing I wanted to do before concluding this presentation was to talk about some current developments affecting the reinsurance segment. And I'm just going to talk about the main ones here, which are hardening rates and COVID. So on the graph here, we're showing property catastrophe pricing on the blue line and third-party capital size on the red line. And it suggests some correlation between the two, suggesting that capacity goes up and pricing goes down, at least to some extent. There is a clear correlation here, but it's also important to recognize that the improvement we're seeing in market conditions at the moment is driven by the underperformance, not by a lack of capacity. Capital remains high in the market, and talking to insurance companies as they go into this year's renewal, people are expecting rate increases, but they're not expecting capacity issues. We're not hearing reports of reinsurers announcing upfront they're withdrawing from programs, for instance. For 2021, here we show a red line with a question mark. It's too early for us to estimate either capital or rate increases for the next year. However, we can see that the rate on line is currently not above that level it had in 2014, and it's clear to us that the price adjustments that we are seeing are going to need to last at least for a couple of years to compensate for the losses we've seen in the last few years. Next slide, please. So I'll talk about COVID, but in context, right, what I just said was that the current market hardening is not the result of lack of capacity as such, but more a response to underperformance. And that's supported at the moment by the impact of the COVID-19 pandemic, which is obviously still an ongoing event. So the magnitude of losses are still very uncertain, and that's reflected in the wide range of estimates for the market loss that we're seeing from various sources. At half year, around 25 billion USD of COVID-related losses had been reported, split roughly equally between insurance and reinsurance, but that's still behind initial estimates. Most of this is IBNR, and there's a big variation of the reported impact on loss ratios between different reinsurers at half year. The impact ranges from 5 to 20 points impact on the loss ratio. Part of that variation is explained by differences in business mix. Event cancellation was a line that gave rise to early losses. And so whether companies have exposure to that is a differentiator. But more importantly, I think there are different reserving approaches, especially to how much IBNR will be established against potential losses for BI, credit insurance, and casualty losses, where there's limited case reserves at the moment. And when looking at COVID, we should also remember that this is an event affecting both life and non-life and both sides of the balance sheet. So, as I said earlier, investment market have recovered, so far, but there is clearly scope for more volatility and bad news in the rest of the year. Next slide, please. So I'm going to conclude where I started with our outlook, our stable outlook. As I said at the beginning, we had a stable outlook going into this crisis, and we've maintained that since to reflect the balance of the head and tailwinds facing this market, as I have discussed them here. However, it is, as I also said, a dynamic stable, and we are watching very carefully developments such as COVID loss emergence, including from BI, rate hardening, as the various renewals happen and the capital inflow to the markets. And I expect we'll be able to explore some of these topics further during the Q&A session of this webinar. But that completes my presentation. Thank you.
Okay, thanks, Matilda. As you said, we'll return to some of those topics later on. And as I said at the beginning, there's more detailed commentary in the our reinsurance report released earlier in the month available on our website. So with that, we're going to move to the kind of second part of the presentation, European primary insurance trends and outlooks. And this is going to be led by Catherine Thomas and Angela Yeo, who are analytical leaders of our teams in London and Amsterdam, respectively. So with that, Catherine, over to you, please.
Okay, thanks, Nick. Just click through the slides. Okay, so in this second quarter of this year, AM Best updated its outlooks on the major insurance markets in Europe. And today, Angela and I will share our insight into the key trends in these markets and touch on the potential impact of these trends on the reinsurance sector. But before we look at the individual countries, I'd like to take a quick look at the overall European market. And this year, it's the operating, financial and economic challenges created by COVID-19 that are dominating the market environment for insurers in Europe. And the overall outlook for both underwriting and investment performance is characterized by material uncertainty. Measures undertaken to combat the spread of the virus have led to severe economic consequences, with most global economies forced into lockdown. And as this chart on the slide here shows, all the major European markets are expected to experience a significant contraction in growth this year. And as economies shrink, of course, so does the value of insurable risk, which will have a clear implication for the demand, clear implications for demand for insurance. Now, the IMF is forecasting that growth will jump in 2021, reflecting some normalisation of economic activity. But these forecasts are highly dependent on the pandemic fading later this year, allowing for a restoration of business and consumer confidence. And it also assumes that government policy actions are effective in combating, containing bankruptcies, containing extended job losses, and system-wide financial strains. So going into 2020, equity markets were nearing record highs, boosting insurers' capital positions. But with the emergence of COVID-19, global equity markets experienced sharp declines in March. And although we've seen some recovery since then, volatility is expected to persist throughout 2020. Bond markets have also been rattled, so corporate bond spreads have widened, with the risk of corporate bond defaults increasing in line with the deterioration in economic conditions. At the same time, we've seen actions taken by central banks, increasing the likelihood that interest rates, which were already at historic lows, will remain depressed for longer. And you can see rates on government bonds in Europe on the chart here. Now, in Europe, the ECB has announced a series of measures to support the European economy, including expansion of the existing asset purchase programme and a reaffirmation of key ECB interest rates. And in July, the EU agreed to the Next Generation EU Economic Recovery Package, totalling €750 billion. In the UK, we saw the Bank of England in March cut its base rate by a cumulative 65 basis points. So it's against this backdrop that we've updated our outlooks on the 5 principal European markets, both non-life and life. So our outlooks examine the impact of current trends on companies operating in particular markets over the next year. And the typical factors we would consider include economic conditions, the regulatory environment, emerging product developments, and competitive issues. And then our company ratings then take into account the manner in which individual entities manage these factors and trends. Market outlooks, like those on companies, can be positive, negative, or stable, and they're updated annually, at least annually, but can be revisited anytime if appropriate. Now, as you can see on the slide here, we have a stable outlook on all the non-life markets with the exception of the UK, and a negative outlook on all the life markets. So I'll begin with that UK non-life market where we have a negative outlook. Now, in recent years, UK companies have had to contend with changes in the discount rate used to calculate personal injury compensation, commonly referred to as the Ogden rate, claims inflation due to higher repair costs, and political and economic uncertainty. And they'll now also have to digest the implications of the FCA's market study into pricing of home and motor business, published today. But of course, this year has been dominated by the implications of the COVID-19 pandemic. In the first half of the year, travel, event cancellation, and business interruption losses were largely offset by lower claims frequency in motor and small commercial lines, while premiums were affected by reduced economic activity and refunds on certain lines of business, such as motor. Now, of course, business interruption has the potential to be a significant driver of the COVID-19 loss for UK insurers. Although most SME insurance policies written in the market require physical damage to trigger a BI claim, a limited number of policies do cover BI from other causes, such as infectious disease. Now, with variations in both the type of cover provided and the wordings used, disputes have arisen as to whether COVID-19 related BI claims are valid. And in many cases, there's been a clear disparity between what insurers believes is covered by the policy and what the insured believes is covered. These disputes prompted the conduct regulator, the FCA, to step in and to bring a test case to the UK courts to resolve that uncertainty under certain BI wordings. And last week, we saw the High Court's judgment handed down. At the time, we commented that we expect COVID-19 related BI claims to have a material impact on UK commercial property insurers' 2020 earnings. but that the aggregate solvency of the overall UK non-life sector to remain robust. Now, in our view, the judgment brings greater clarity to insurers and policyholders in respect of the interpretation of BI wordings. But I think there remains quite a bit of uncertainty around the volume and severity of valid claims, as either side, of course, may appeal the court's decision, and the test case does not directly address how resulting claims payments will be calculated. Now, in the reinsurance sector, companies have responded to that uncertainty by adding contagious disease exclusions to contracts. This year, UK property insurers will also be hit by weather losses, which to date are up on the same period last year. But the extra spending on flood defences announced by the government back in July was, of course, widely welcomed by insurers. Changes to the personal injury compensation system in the Civil Liability Act 2018 should be a positive for UK insurers. But many of the provisions in that act are yet to be implemented. And the delay in the implementation of the Whiplash Reform Programme from August this year to April next is, of course, disappointing for motor insurers. Now, the Act has also changed how the Ogden discount rate is set. The rate was revised from minus 0.75% to minus 0.25% in July last year. But this increase fell short of market expectations, and a number of insurers had to strengthen their motor and liability reserves. Excess of loss reinsurers were also disappointed, and we saw some market-wide repricing of motor liability business. Political and economic uncertainty associated with Brexit continues to weigh on the UK non-life insurance market. Although from an operational point of view, we see UK domiciled insurers as generally well prepared for the conclusion of the transition period at the end of this year, with those that intend to underwrite business in the EU going forward having put in place arrangements to ensure that they are able to do so following a loss of passporting rights. Now, moving to the UK life market, where in April this year, we moved our outlook from stable to negative due to the material uncertainty as to the severity of the impact of a COVID-19 driven financial market volatility on capital. There are also concerns about an increase in the risk of corporate bond default and the negative impact on investment returns of lower reinvestment yields. We do note, though, that UK life insurers' assets and liabilities tend to be well matched, which of course reduces the sensitivity of balance sheets to interest rate movements. And we expect the impact of a rise in mortality claims due to COVID-19 to largely fall within the boundaries of insurers' pandemic scenarios that they've run as part of existing stress tests, noting that exposure there is generally well protected with reinsurance and that the impact of losses should be at least partly offset by a positive impact on longevity experience. In the UK, the active product profile of life insurers has become increasingly concentrated over the past 10 years. We now see pension-related products dominating portfolios. And we expect the defined contribution pension savings market to continue to grow, supported by regulatory increases to minimum contributions. In the bulk annuity space, we expect the funding of transactions to be negatively affected by current market volatility. But we do expect the appetite for such deals to return to 2019 levels in the medium term. And I think that's, the low interest rate environment and de-risking by sponsors has resulted in DB pension plans holding quite very low return assets. At the same time, we've seen pricing for bulk annuity transactions begin to incorporate a portion of the benefit insurers can obtain from holding illiquid assets. And these developments together are supporting growth as pricing has become more affordable for some potential clients. Of course, the pool of relevant DB pension assets for bulk annuity insurers is a limited one that will eventually be exhausted. But I think in the medium term, the outlook is pretty good and is dominated by a pipeline of transactions and continued growth in holdings of illiquid assets by UK insurers, largely related to their annuity business. In general, we would view that move by insurers towards a higher allocation to illiquid assets as an appropriate way to create value from their role as gatherers of illiquid liabilities, but it will require careful management by insurers. So default experience has been extremely benign in recent years, and good data for periods of pressure on the value of private assets is just not easily accessible. And we would consider default and valuation uncertainty for these assets as having increased in the current economic environment. Now, a key consideration of UK insurers writing annuity business in the Solvency II is the Solvency II risk margin, which for longevity uncertainty we see as being can be an uneconomic regulatory burden, as it can be unusually high for longer tail liabilities. Now, for liabilities that enter the insurance system before the introduction of Solvency II, the effect can be offset by transitional measures. But liabilities newly transferred from DB pension funds require other measures. And as a consequence, we see many UK insurers reinsuring this risk, usually with a reinsurer outside the Solvency II regulatory regime. Now, that risk margin could eventually change either through an EU mechanism or a UK-specific process. And I think it's worth noting that in June this year, the government did announce plans for a review of the Solvency II regulatory regime once EU rules no longer apply. And that, of course, could lead to, if there is changes to that risk margin, treatment of that risk margin, this could lead to changes in UK insurers' appetite for reinsurance in respect of their longevity risk. So I think that's definitely something to watch there. And I just want to move across the channel and move to the French market, and starting with the outlook on the French non-life market, which we've maintained as stable, reflecting resilient profits in spite of difficult operating conditions. Growth over the last 5 years has been pretty unremarkable, but did pick up last year, supported by higher motor premium. This year, lower premium levels are likely to be reported due to a drop in commercial activity, though, as a result of COVID-19 related restrictions. And we've seen the French state as being proactive in supporting the economy, including French insurers. So, for example, in April this year, CCR, the state-backed reinsurer, announced support to the domestic credit market through a €10 billion reinsurance programme, similar to that launched in response to the financial crisis. In the medium term, we expect premium rate increases to continue to keep pace with claims inflation, but strong competition in this market is likely to constrain more substantial increases. We've seen legislative changes in recent years, such as the Hamon Law and the subsequent Berquin Amendment, which have increased the ease with which policyholders are able to switch insurance policies, have only really served to heighten the price-based competition in this market. Now, contributing to that competitive nature of the French non-life market is the strong position of mutual insurers there, who make up about a quarter of that market. And the absence of shareholder pressure for these insurers allows them to manage their portfolios at higher loss ratios. But in spite of that competitive advantage, increasing regulatory burdens and a hunt for economies of scale have driven a wave of consolidations and strategic partnerships in recent years, leading to the creation of some pretty large mutual groups with leading positions in their core lines of business. And the competitive landscape does constrain French insurers' underwriting profits. And as you can see on the graph here showing the combined ratio, and you can see for the overall non-life market, that's hovered at around 100% over the past 10 years, with weaker performance in motor being offset by stronger performance elsewhere. This year, claims experience directly related to COVID-19 we think will be largely manageable for diversified companies. But certain lines will be heavily affected, such as trade, credit, travel, professional indemnity, and event cancellation, as elsewhere. Some insurers will see business interruption claims related to the pandemic, and we've already seen some disputes over cover going through the French courts. In respect of cat business, France has a well-established Nat Cat scheme which protects private insurers' balance sheets from volatility stemming from peak risks, and has played an important role in the sector's resilience to adverse weather events. That scheme includes the availability of reinsurance cover without policy limits provided through CCR. And CCR is the only market participant to benefit from a state guarantee. And as a consequence, about 90% of cedants choose CCR to cover their cat risk, limiting to some extent the opportunities for private reinsurers. In spite of that, at the 1/1 renewals, commercial reinsurers' appetite for French property business was strong, as was that of cat bond investors, demonstrated by the placement of Covéa's €120 million French Windstorm bond. Now moving to the life market in France, where we moved the outlook to negative in April in response to the significant market volatility and economic uncertainty generated by the COVID-19 pandemic. This created additional headwinds for a sector where technical margins have already been under some pressure for several years now due to the low interest rate environment. So the French life sector is really dominated by savings, by the savings market, where life insurers enjoy a privileged position with insurance savings products representing about 40% of household savings. And we've seen premium in the sector grow steadily in recent years. Although the economic effects of COVID-19 driven recession are likely to depress premium levels in the medium term, as households will have less disposable income to invest in savings contracts. The segment has a conservative investment portfolio overall, but corporate bonds and collective investment undertakings together represent about half of investments. And it's through these investments that solvency levels are sensitive to changes in credit spreads. Ahead of the pandemic, the segment results were already challenged by the persistent low interest rate environment, with yields on French government bonds or OATs near historic lows across all terms. And yields on OATs are expected to remain low through the medium term. French life insurers are particularly sensitive to the interest rate environment because of the predominance of traditional insurance savings contracts or euro-denominated contracts, which account for more than 70% of their premiums and 80% of reserves. Here, insurers bear most of the investment risk on these contracts, as the policies carry accumulation guarantees. And as higher yielding investments have matured and have been reinvested, portfolio yields have, of course, continued to drop. Low interest rates are expected to continue to pressure the segment's results, as contract guarantees can constrain insurers' ability to profitably manage their books. Of course, widening of credit spreads on corporate bonds may somewhat offset this trend, provided there is not a corresponding increase in default rates. The industry has been pretty proactive in responding to the low interest rate environment by consistently lowering the bonus rates on traditional savings products. You can see that on the bottom chart here. And we expect bonus rate reductions to accelerate as interest rates remain at depressed levels. And overall, we consider French life insurers to be better positioned probably to navigate the low interest rate environment than, for example, their German peers. Estimated average guarantee on traditional business is around 0.5% for in-force business and 0% on new business. Also, in recent years, we've even seen the insurers selling traditional products with 0% guarantee growth and management fees, so effectively offering negative guaranteed rates. Now, as well as lowering bonus rates credited to traditional savings contracts, French insurers have continued to strengthen their deferred profit sharing provision, the PPB, to support future bonus rates to be credited to those euro-denominated policies. And I think in our view, this increased conservatism is a positive factor, as a higher PPB increases the resilience of insurers' balance sheets and future results. Although traditional savings products dominate French insurers' balance sheets, unit-linked offerings, as elsewhere in Europe, have become a more important part of their business. You can see that on the top chart here, showing the inflows for savings contracts. And the share of unit-linked in direct savings premiums has gradually increased over the past 10 years, driven by insurers' efforts to develop this capital-efficient segment in order to protect their profit margins and solvency levels. So with that, I'll hand over to Angela to cover the rest of the market outlooks.
Lovely, thanks, Catherine. So I'll carry on, gone too far, with the German non-life outlook. And AM Best has affirmed the outlook for the non-life segment for Germany at stable. The technical profitability, as it was noted in the past, is expected to maintain in the medium term. This continued trend is mainly supported by stable to positive rate adjustments. Investment returns are not expected to contribute significantly to the earnings of German non-life insurers due to further pressure on interest rate levels and volatility in the financial markets caused by the COVID pandemic. Germany's economic fundamentals had already weakened during 2019, and real GDP stood at 0.4% at the fourth quarter in 2019. The IMF forecast projects a contraction of GDP of 7% for 2020 and a rebound of 5.2% for 2021. According to the IOPA, the gross written premium grew by about 6% in the fourth quarter of last year, compared to the fourth quarter the year before. AM Best expects premium levels to decline during 2020 and into 2021 based on the effects from the COVID pandemic on the economy. Over the past 5 years, the overall German non-life sector has achieved combined ratios in the range between 93% and 96%. For 2019, we saw a strong performance with combined ratios of 93%, which was supported by much better claims experience and hardening rates in the industrial property subsegment, as well as a generally low Nat Cat experience. In the absence of large Nat Cat events, AM Best would expect the technical profitability of German non-life insurers to be sustainable over the medium term, also due to good underwriting discipline and good cycle management. For many subsegments in the market, competition remains a main challenge that puts pressure on rates. That in turn has shifted the focus of insurers onto product initiatives and service provisions. Low interest rates, or better put, the continuation of a low interest rate environment, dampens investment results. In order to enhance yield, some companies have slightly shifted towards increasing their credit risk somewhat by having a higher exposure to corporate and non-EU sovereign bonds. Due to the market volatility and economic uncertainties, AM Best expects the German non-life market players to continue to focus on underwriting discipline and pricing discipline in order to maintain underwriting profitability. Capital adequacy remains robust, as evidenced by a strong SCR ratio at fourth quarter 19 of 292%. We would like to note, however, that this ratio varies largely by individual insurers. Moving on to the life outlook. As you've seen earlier, AM Best has put all the market outlooks for life on negative, and the German life outlook had been negative in the past, so we have affirmed this outlook. The German life segment's in-force portfolio is still dominated by traditional products with high guarantees. These levels of guarantees are no longer supportable given the current low interest rate environment, together with the financial market volatility and current economic environment as caused by the COVID pandemic. AM Best does not expect this trend to ease over the next 12 months. In response to the lasting low interest rate environment, the German life insurers have focused on reducing the bonus rates for policyholders, as well as adjusting their business mix. Hybrid products and capital-light products or unit-linked products have contributed to reducing the proportion of new premium income from traditional products. Low interest rates and consequently low returns on newly offered long-term guarantee products have not hindered the demand for life insurance and retirement products. In fact, new business as measured by annual premium equivalent grew by around 19%. Interestingly, this growth was driven actually by the low interest rate environment. I'll explain. Policyholders seek saving solutions with higher yields. However, banks are no real alternative since the introduction of negative interest rates on large bank deposits. Investment yields declined to 3.6% in 18 compared to 4.5% in 2017, according to the GDV. In an attempt to improve this, a modest but gradual shift in asset allocation could be seen over the past years towards a higher exposure to equities, infrastructure investments, but also lower quality assets. ZZR, a unique German market feature, namely an additional reserving requirement to cover any funding shortfalls, has also put pressure on the German life segment. A reference rate to calculate the ZZR contributions is set by the Bundesbank in September every year for the full year. This rate depends on the long-term interest rate, and in 2019, this rate was lower than anticipated at 1.92% compared to 2.09% in 2018. A projection based on the assumption that the long-term interest rate of August 2020 will remain unchanged until the end of September, which is the time when the reference rate will be set, the rate is expected to reduce even further to 1.73% for the year 2020. Although most German life insurers reported strong Solvency II SCR ratios at year-end 19, the challenges brought on by COVID will put negative pressure on operating results and capital over the next 12 months. Moving further south, we'll go to the non-life outlook for Italy. And AM Best has affirmed a stable outlook for the Italian non-life segment. The main factors for this decision include the fact that the sector has demonstrated resilience to a challenging macroeconomic environment that is supported by sound solvency levels that include a buffer to absorb a degree of financial market volatility. The average combined ratio of the segment has been below 95% since 2013. This compares favorably with that of other developed insurance markets. Most insurers have well-diversified books, showing growth in the more profitable non-motor segments, which has served to offset motor's poorer performance. While technical profitability is deemed sustainable over the medium term, it should be noted that overall earnings in 2020 will likely be impacted by volatile investment returns and the potential for asset devaluations as a result of COVID-19. And this will be one of the main consequences of this pandemic for the non-life segment in Italy. Asset devaluations, as just mentioned, will be driven mainly by two variables: the volatility in spreads between the Italian and the German bonds, and the high volatility in equity markets, as witnessed in recent months. We do note, however, that although the exposure of Italian non-life insurers to sovereign debt is considerable, the sensitivity of the balance sheets towards changes in credit spreads is significantly lower than that of life insurers due to the shorter duration of non-life carriers' investment portfolios. So we expect the solvency position of non-life companies to be more stable. GDP growth and non-life premium growth are highly correlated in the Italian market. We expect the non-life market to report a modest growth for 2019, partially through the continued development of the non-motor segment, but also through increases in motor premiums, which grew for the first time in 2018 since 2013. However, as alluded to earlier, given the impact of the pandemic on the Italian economy, we do expect a negative impact on premium levels for 2020 at varying degrees. Moving on to Italy Life, the life outlook for the Italian segment has been set to negative. The Italian life insurance market actually experienced solid growth. Gross written premiums rose by 3.5% in 18 and another 4% in 19. Unit-linked and hybrid products have been developed in recent years in an effort to reduce the average guaranteed rate of return in the overall savings book to below 1%. Hybrid products contain elements of both traditional guarantee and unit-linked products. Interestingly, in 2018, the volume of traditional products grew for the first time since 2014 by around 7%, and another 7% in 2019. On the other hand, the volume of unit-linked dropped by 4.5% in 18 and by a further 7% in 19. This trend could also be observed within the hybrid products. The main reason underpinning this trend is the increased demand from policyholders for stable yields in response to the spike in volatility in equity markets during 2018 and 19. In 2020, as the economic situation in the country worsens as a result of the COVID-19 pandemic, we expect a decrease in overall net financial savings, which will negatively impact the demand for insurance savings. Investment returns are expected to remain comfortably in excess of average guarantees. One of the reasons for this is that interest rates on Italian sovereign bonds is not as low as in other European countries. Investment returns for traditional policies stood at 2.3% in 18 and remained above 2% in 2019, which compares positively with an average guarantee below 1%. Technical results for 2019 were improved, and the return on gross written premiums was 5.8%. In 2020, of course, the technical result will depend on how the COVID crisis evolves, but it is likely that we will see poorer results driven by asset devaluations across the investment portfolio. Risk-adjusted capitalization in the Italian market has remained at a good level in recent years, evidenced by an average Solvency II SCR ratio for the market of 223% at the end of 2018, which improved slightly to 235% at year-end 2019. The life insurance sector is highly exposed to Italian sovereign risk through investments in government bonds, which account over 40% of the investment portfolio, despite efforts to reduce their exposure. A high allocation to Italian government securities is attractive to life insurance, as they can provide a sufficiently long duration to match insurance liabilities and provide a relatively good return while incurring no capital charge for spread risk under the Solvency II standard formula. In our view, there is a buffer in the solvency levels of Italian life insurers to absorb a degree of pressure on their balance sheets. However, the segment faces significant headwinds in 2020 due to the impact of the COVID-19 pandemic on the country's economy. Premium volumes are expected to decline, and operating results and solvency levels are likely to be affected by asset devaluations and ongoing financial market volatility. That is the reason why we changed our outlook on this segment from stable to negative. And our last country outlook is for the Spanish market. The Spanish non-life outlook has been affirmed at stable. The main factors supporting this decision are a resilient performance against a backdrop of political turbulence, strong technical profitability, and a well-capitalized market. The Spanish insurance market has undergone some competitive market conditions, political turbulences, as mentioned already, and a slowing economy over the past years. Despite these, the non-life market has continued to display solid underwriting discipline, which in turn has produced strong underwriting results. Technical profitability is one of the highest in Europe, supported by overall stable 10-year combined ratios ranging from 93 to 95%. Spain's real GDP and gross written premiums are again closely linked, although the real GDP has gradually slowed since 2015. It was still above that of the Eurozone over the period 16 to 19. Gross written premium grew by 3.4% in 2019. AM Best expects the GDP to contract in 2020 due to the COVID pandemic, and hence this will create headwinds for the Spanish non-life sector and will likely lead to a reduction in premium volumes. Decesos, or funeral expenses insurance, a very popular product in Spain, is expected to be directly impacted as a rise in mortality will likely contribute to higher claim numbers. However, AM Best considers Decesos writers to be well placed to absorb higher loss ratios. The compulsory government natural catastrophe scheme, which covers physical damage caused by natural catastrophe events in Spain, has been proven efficient over the years and has been a mitigating factor in reducing volatility around the technical results. Asset allocations of Spanish non-life insurers is generally relatively conservative, and according to EIOPA, a return on assets of 8.6% was achieved for 2019. However, and this is a recurring theme, yields on government obligations are expected to remain low through the medium term in the face of measures announced by the European Central Bank to support the European economy. The Spanish insurance market remains well capitalized. At the fourth quarter 2019, a market-wide Solvency II SCR ratio of 247% was reported by EIOPA. Moving on to the Spanish life outlook. The Spanish life outlook has actually been published for the first time this year, and in line with other European countries' life outlooks, Spain Life has been placed on a negative outlook based on a number of factors. As mentioned in the previous slide, Spain's GDP and gross written premium developments are closely aligned. The GDP has been forecast by the IMF to decline by 8% in 2020. In addition, the spread between Spanish and German 10-year sovereign bonds are as well as the spread of corporate credit has widened, not to mention the decline in equity markets. In 2019, the gross written premium for the Spanish life market fell by 5.1%, a continuation of decline since 2017. This is largely due to the reduced demand for traditional savings products. As per other EU market players, Spanish life insurers have shifted their focus on the sale to unit-linked products, which help to partially offset the decline in traditional products. Spanish policyholders tend to be risk-averse, and as such, the recent market volatilities will likely increase the perceived riskiness of unit-linked products, making them less attractive. Spanish life insurers have reported healthy profits over the recent years and ended in 2019 with a solid 8.7% return on gross written premiums. This profitability is supported by a stable competitive environment with high barriers to entry the market. Also, local regulatory requirements to closely match assets and liabilities have helped reduce sensitivity to interest rate movements. The overall market remains well capitalized, as previously mentioned. COVID-19 is expected to depress insurers' capital adequacy for all the reasons highlighted. However, the segment's conservative investment strategy, with around 2% of assets invested in equities, provides a buffer in solvency levels to absorb a degree of financial market volatility. Just to summarize, in light of the ever-evolving situation around COVID-19, our analysts are in constant communication with their clients and are following market developments. In AM Best, our research teams and our team of economists are updating continuously on global market trends. There are a number of things to watch over the coming months and possibly even years, as uncertainty still remains in many areas of our industry. Thank you. With that, I'll pass back to Nick.
Okay, thanks, Angela, and indeed to Catherine for our tour of Europe, which I hope you you found interesting. So we're now going to move to something of our panel session with Q&A. So I think we're going to bring everybody up again. Hopefully we've got everybody. Yeah, excellent. So maybe to start with, and perhaps this is one for you, Catherine, and we've had a number of questions in relation to this topic, but just referring back to the FCA case, the judgment, the High Court judgment that came out last week. You touched on that during your prepared comments, but what do you see? What are we going to expect now? What's going to happen next, and what do you see the implications, particularly for reinsurers?
Okay, so I think our view certainly is that, you know, the judgment provides policyholders with some increased clarity as to whether they will receive payment from their insurers, a process that may otherwise have been quite lengthy and certainly more costly for them. And for the insurers themselves, they now have a better understanding of which of their policies are expected to respond to these types of claims. Having said that, it's clearly a very complex judgment, and UK insurers will need time to fully digest the details and to understand what it means for their own portfolios. And this will depend very much on the mix of wordings that they have used. Also, either side could appeal the court's decision, although I think here it's worth noting that parties to the case have already agreed that they will seek to have any appeal heard on an accelerated basis. And insurers, I think, will need to consider the reputational implications of any appeals. So the judgment concluded that most disease clauses in BI policy wordings did provide cover, so largely in favour of the policyholder. But denial of access wordings were found to be more restrictive, and the validity of these claims very much hinge on the nature in which the COVID-19 restrictions affected individual businesses. So, for example, if a business was ordered to close completely or not. Now, following the judgment, we've seen the FCA write to insurance company CEOs, setting out their next steps and the expectations of insurers over the coming months. So in those cases where insurers have policy wordings affected by the case and relevant questions are not subject to appeal, the regulator has certainly encouraged them to conclude the claims process with their customers as quickly as possible. In those cases where an insurer may appeal a specific point in the judgment, they're expected to write to their policyholders, clearly advising their next steps as soon as possible. Now, of course, a key factor in determining the financial impact of the case on individual UK insurers will be their ability to make recoveries from their reinsurers. And we've already seen a number of market participants stating that they expect to make some material reinsurance recoveries, limiting their net loss. Structures of programs purchased will, of course, vary from company to company, with recoveries dependent on deductibles and limits. And I think there's quite a bit of uncertainty as to the extent to which COVID-19 claims will aggregate both within and across different lines of business. And that will determine whether cover is triggered and if limits on excess of loss contracts are reached. One thing there was in the judgment, the definition of an event or occurrence that triggers the reinsurance cover is, of course, important. And while we do think, loss triggers are likely to be a source of dispute, and I think we've seen that in France, there was clarification as part of the test case that the COVID-19 pandemic and the government and public response form a single cause of a covered loss, so the insured peril. You'd see dispute risk between insurers where quota share cover is written back to back, with the insurer committed to following the fortunes of its cedant much lower.
Okay.
I think maybe to add there, if we look to continental Europe, right, it is now clear that BI losses are a feature of some markets and not others. So in Germany and France, BI losses have already emerged, but there are also countries where we now think it is pretty certain that we won't see BI losses. It's in Italy and Spain. I think that's interesting and will certainly help to lower the overall losses that we see. And the other thing I wanted to add is that, Catherine mentioned dispute risk, and we are hearing of disputes between reinsurers and insurers at the moment. So we called this out, I think, very early on, that there was dispute risk here on how these losses would be covered by reinsurers, and I think we are starting to see that actually happening now. So it's definitely an interesting topic to follow in the next many months, probably.
Yeah, for sure. I think it's fair to say there was significant global interest in the UK court decision, albeit terms and conditions are different in different markets, but certainly I think a lot of the world's markets were following that case. Okay, I'm going to move on to another topic, and this is something Matilda, briefly you mentioned, which is quite a specialist line, trade credit reinsurance. Clearly an impacted line in relation to the COVID-19 situation. But again, what do you see going forward with this line in terms of availability of coverage, terms and conditions, pricing?
Yeah, I think maybe to cover the losses first. So trade credit insurance is a cyclical line, right? And it means that there's a clear correlation between challenging economic conditions and increases in insolvency rates amongst companies, and therefore also trade credit insurance claims. And trades, the primary business here, cede quite a lot to reinsurers. So we would see that same. We would see if there are significant losses, we would expect them to impact reinsurers. So at half year, we saw a number of reinsurers include trade credit insurance, reinsurance losses amongst their COVID-19 estimates. But this was mainly IBNR, and so the ranges, right, the estimates they put up varied quite a lot. They're mainly IBNR because we haven't actually seen many case losses yet. There is obviously a natural delay between economic trouble and insolvencies, but that is perhaps extended in this crisis due to government support for the economy. So the question is, when will we see losses, and will we see losses? I would still expect insolvency rates to rise with the hit we've seen to the economy, and so there is still I would still expect losses for this line. There are some factors that mitigate that loss, that help us think that it's going to be less of a loss than it could have been. One thing is that the pause button we've had with lockdowns have given trade credit insurers time to take actions on their portfolios. Right, trade credit insurers have the ability to cut exposure to industries or individual buyers that they think are at risk, and also to adjust pricing quite quickly. So they can adjust their exposures fairly radically when they want to. So that will certainly help to mitigate the losses we'll see on the primary side, and therefore also passed on to reinsurers. And the other thing is the government scheme that's been put in place in a number of countries to support as support for trade credit insurers, but really to support the economy, right? To ensure that trade credit insurance capacity remains in place. If there are losses that emerge, then in those countries, a lot of those losses would be passed on to governments at the moment. But of course, this isn't a perfect mitigant. There are important markets that are not covered by any schemes, and also the schemes are due to expire by the end of this year. There is discussion at various levels about whether they should be extended, but we don't know yet. So that was a long answer, right? But it's a line that we keep a very close eye on. We haven't seen much loss activity yet, but there is potential for losses to emerge. In terms of what I see on in terms of the actions that they take, right? I can't sort of give you a sense of how much rate increase that they're getting. I would expect it to be very targeted, right? There are obviously buyers in this environment that are doing perfectly fine, like supermarkets, right? Have no trouble with them, no trouble in this market. So I would expect the rate increases to be the actions to be very targeted, and therefore hard to quantify on a portfolio level. I think in terms of exclusions, it's not a line where I would expect pandemic exclusions, although the pandemic is a surprise to us all, and a new situation for us. Recessions are not, right? They come along with stable regularity, and trade credit insurers are there to cover a lack of payments from insolvency. So I wouldn't expect that to be exclusions, but more for the insurers to take advantage of the actions that they already have in their portfolios to manage higher risk situations such as this one.
Okay, thank you, Matilda. So maybe staying with the COVID-19 theme, and maybe this is one, we've had a sort of few questions in relation to this one for you, Angela. Earlier in the year, as the pandemic was sort of coming out in force, AM Best conducted a specific COVID-19 stress test, and I wonder if you could just sort of outline what that stress test was and what the results were at a high level.
Sure. Yeah. Yes, Nick. As you said, we actually very early on reacted to the situation. We started actually off by sending out a questionnaire to our rated clients community to better understand the preparedness and the expected impact this pandemic might have had on the insurance and reinsurance companies. The questionnaire was fairly simple. We asked 4 questions, generally in regards to how the company's operations were impacted, how business was conducted, and how it would impact the financial position, whether companies had made changes to previously modeled stress scenarios, and whether the anticipated impact would fall within their risk appetite and tolerance, what adjustments companies were planning to make to their 2020 financial projections, or changes to their key assumptions, and then lastly, if they have made actually any changes to their internal stress testing and sensitivity analysis. So that initial feedback that we received from that questionnaire, we used in combination with our own Bakar stress test that we've conducted globally. Now, we've decided back then to run a rather conservative baseline stress test in the first instance, which focused on underwriting and asset sensitivities. So we made adjustments to the net required capital and the available capital. The model was run based on the 2019 financials pre-COVID, and the PACAR was assessed at the 99.66 percentile level. So, for example, on the underwriting assumptions, or assumptions that we made on the underwriting side included increases in mortality for health and commercial lines. We looked at claims, increases in loss ratios, and then we looked for annuities. We looked at the ALM mismatches. From a credit perspective, we downgraded the fixed income securities by 1 rating level. We applied haircuts to mortgage loans, equities, real estate, and alternative assets. We also made some adjustments to available capital. For example, on the soft capital component, we applied a haircut to any credit that was already given in the model. So it's very high level. Anybody who's interested in more details, there is a publication on our website on that. So basically, it was a very, let's call it a blunt instrument approach that helped us identify companies or trends that required further, where we required further information on. We had communication with the clients and monitored certain either regions or companies. It's important to mention that the stress test was really the first step in the process, and it was only looking at one component of one building block, i.e. the PACAR. In regards to the questionnaire responses, just very quickly, there were no major surprises for us. We had a very good response rate globally, providing us with feedback from a very diversified portfolio of companies. The underlying common theme was, of course, uncertainty, as we heard many times today already, and it still is. The majority of companies were able to execute on their business continuity plans. They were able to fully operate. Successful execution of ERM strategies was another area we could positively identify. Now, rated companies within the EMEA region are mostly P&C and composite reinsurers and insurers, as opposed to our US portfolio, which has a large proportion of life and health companies in the mix. In addition, our companies tend to be higher rated companies, as we are operating primarily in CRT1 to CRT3 regions. These regions have shown greater stability, and PACAR scores were generally above the strongest threshold. When comparing insurance companies with reinsurance companies, it can be said that amongst the bigger players, there was little differences. Smaller companies, of course, have shown greater volatility, especially for companies with small and concentrated profiles. The P&C segment is experiencing potentially material headwinds. However, existing strong capitalization will help to act as a buffer. So overall, the PACAR scores withstood the stress test in our region, and we expect earnings likely to be impacted this year, with the materiality still uncertain at this stage.
Okay, thank you, Angela. We should probably just explain for those who are not quite so familiar with AM Best methodology that PACAR, the PACAR acronym stands for Best Capital Adequacy Ratio, so that's the output of our own capital model, and CRT is country risk tier, which is the tiering system we use for evaluation of country risk. But again, there's very detailed explanations of our methodology on the website. So
I wanted to add, Nick, that Angela has talked about the stress test there, but since then, we've continued to have very close contact with companies where we think there is a potential stress, or where they are in a line of business or in an area where there's more stress. So our analysts talk to their companies when they need to, and we have certainly talked to companies more than we perhaps have in other periods in this environment. Lots of video calls with
for sure
contacts.
Okay. Got a question in here actually regarding the Lloyd's market, which again we sort of touched on during the reinsurance session, but and maybe this is one for you, Catherine, as you're obviously very closely involved with the Lloyd's market based here in London. I mean, Lloyd's released their half-year results, I think it was last week. Clearly some COVID impact, but can you give a little more sort of colour regarding views on the Lloyd's 6-month results for this year's?
Yeah, so I mean, it's clear that COVID-19 will be a material loss for the Lloyd's market. In those results, it stated that it expects to pay £5 billion out in gross losses, and in the first half of this year, net claims totaled £2.4 billion, which adds almost 19 points to that half-year combined ratio. So it is a material loss. I think it's worth saying, though, that, and Matilda alluded to this in her presentation as well, solvency remains strong because we saw members' capital injections and surpluses covering £3 billion of COVID losses there. Now, from a claims point of view, event cancellation is the key affected line, with exposures dependent on policy wordings, specifically whether cover for pandemics is excluded, and on whether events have been fully cancelled or merely postponed. And I think Beazley put out an announcement this morning materially increasing their COVID loss estimate. And part of that is driven by assumptions around whether events are going to now be cancelled rather than before it was assumed that they're going to be postponed. And they've, in their assumptions as well, they've also delayed it as to when they expect a resumption of business as normal. So I think that was an interesting thing out in their announcement this morning. Property policies, of course, have been hit by business interruption claims, and over time, we'd also expect claims from trade credit and surety and mortgage reinsurance to emerge. Medium-term financial lines such as D&O and E&O are likely to be hit by claims, for example, resulting from accusations of poor contingency planning or failing to manage business disruption. Cushioning some of that COVID blow was an improvement in the underlying attritional loss ratio, which, of course, is viewed favourably, and a demonstration both of some of the remedial actions we've seen being taken at Lloyd's, particularly by the Performance Management Directorate, and also a function of improving rates and improving market conditions. I think one thing that is interesting with Lloyd's, perhaps, is from an operational point of view, there have been, clear implications for a market that deals with complex, bespoke business, with, transactions often negotiated on a face-to-face basis. But I don't think they've necessarily been a negative. The pandemic really has thrown into focus the market's modernisation efforts. It's demonstrated that progress made by individual insurers on this journey could be a real differentiator, and it's forced individual companies and to be more thoughtful about the circumstances in which in-person interaction might not necessarily enhance value, and what could be done better and more efficiently electronically. And we've seen a marked increase in use of the e-placement platform PPL.
Okay, I guess with Lloyd's and other markets, we've seen new capital inflows coming in various forms. What do you see as driving this, and how do you see this capital is going to be deployed? And maybe, Catherine, you might start on that one, but I think the others may have some comment.
Yeah, no, it's an interesting one. And, you're certainly right. We've seen a number of existing companies, particularly specialty insurers and reinsurers, raising both debt and equity capital. And, these companies have raised capital both to bolster their balance sheets in response to uncertainty as to the potential scale of the impact of COVID-19 related losses. But they've also been emphasising that it's to take advantage of favourable market conditions. So, going into 2020, commercial lines companies were pretty optimistic. Rates in a number of lines were already beginning to harden. As we saw increased discipline in response to some unfavourable claims trends, higher than average cat losses, but also social inflation in the US. And this year, as insurers have responded to elevated claims experience driven by COVID, and we've seen further constraints perhaps on capacity, we've seen rate hardening accelerate. And that's a trend that we expect to continue, at least in the short term. Now, coming to where we see particularly attractive opportunities, I think as insureds find it more difficult to place risks in their home markets, we've seen more business flowing into wholesale markets such as London, and as a result, we're seeing particularly attractive opportunities in specialty US E&S lines and reinsurance markets. And I think it's interesting, we've seen these insurers raise equity with relative ease and often with a boost to their share price. They've also been able to issue hybrid debt at relatively favourable rates in spite of higher credit spreads. And I think that suggests investors have, confidence in the near-term prospects of the sector, despite COVID-19 uncertainty, social inflation, the Atlantic hurricane season. New capitals also, as well as coming in to support existing enterprises, we've also seen speculation that it's looking to support some new company formations. And I think that's, perhaps a surprise, given that, in recent years, ILS has given third-party capital an efficient way to move in and out of the market. And that had really dampened, ours and many other industry observers' expectations of new company formations. And I think, as Matilda discussed earlier on the, flows of third-party capital, we do expect, third-party capital to remain a feature of reinsurance markets. It's typically focused on widely modelled property cat exposures, and I think some of the opportunities that are presented by the current hardening market and potentially reach into much broader exposures. So, US casualties, an obvious example there.
Okay, a kind of related question we've had in. So AM Best, or the question comes, AM Best rates new entrants, startups. That was the question or the assumption. So maybe you can just affirm that, Catherine. But maybe can you just touch briefly on how we look at a new entrant into the market in terms of methodology?
Yeah, no, absolutely. So we do rate new entrants. We have a specific criteria to do so, and we need certain conditions and factors to be met. So firstly, we need a clearly defined 5-year business plan, which all the principals are in accord and well qualified and capable to implement. Initial financing needs to be in place or expected to be paid in to capital of the rated entity along with that initial rating assignment. We expect to see an experienced management team and appropriate staff and operational infrastructure in place. And then in terms of interaction, we expect management, board members, strategic investors and other advisors to be available for discussions with us and to provide a comprehensive disclosure of required information. And then, of course, there's a follow-up process to measure the effectiveness of those initial business plans and to monitor companies' strategic and financial development. I know you asked me to be quick, but I think it is just worth noting that over the years we have evaluated many startups that have not met the requirements to achieve what they have considered as a necessary rating commercially. And in other cases, companies have revised business plans to achieve such ratings. And new companies do have, some significant hurdles to overcome when they're looking to establish themselves quickly to take advantage of these beneficial market conditions, securing capital, regulatory approvals, licenses, underwriting teams, as well as, most important thing, gaining market acceptance.
Okay, thank you. So I guess we'll just have to wait and see whether a class of 2020 emerges or not. We're more or less up on time. So I'm going to draw things to a close now. Thank you very much to our presenters and panelists. Thank you particularly to the audience and the questions that we've had in. If your question hasn't been answered, we will try and get back to you one-to-one. Thanks also to, we have a team both in London and the US supporting this webinar and our other webinars. So thank you very much to that team. There will be a playback of this webinar. It will be available on our website probably within the next 24 hours. So if you want to watch it again, you'll have the opportunity, but more likely maybe you may want to recommend it to hopefully to a colleague, and you'll also find a playback of our kind of original Monte Carlo briefing of a couple of weeks ago that goes into another level of detail on the reinsurance side. So with that, I will thank you again, and we'll close off the webinar now. Thank you.